How to make a bad trading strategy profitable using quant mathematics. This video will blow your mind. Just sit down and relax and watch it, or put in your watch later and just watch it while you're focused later on. But you have to watch this video. So let's just begin with the slides. So how to make a trading strategy profitable using quant mathematics. How to make a bad trading strategy profitable. So unlocking profitability by engineering the trading environment, not the core strategy. So we would not be changing the win rate, the risk reward, and all those things. You can find lots of videos, how to like make your strategy profitable by, increasing your risk reward from like 1 to 20 or 30, all those BS things. So let's just move on. So the illusion of trading perfection. Most traders are fixated on three components: the win rate, risk reward ratio, and trading psychology. These are often seen as the only lever for success. The win rate is obviously the percentage of trades that close profitably, and the risk reward is the ratio of potential profit to potential loss on a trade. And the psychology is basically the emotional control and discipline in executing trades. But today we are not improving entries, we're not improving risk reward ratio, we are not improving win rate. Instead, we will engineer the environment around the trades using quantitative mathematics to make us profitable. Okay, let's go ahead. Time of day exploitation. Now we're just, into the practical stuff, and this is the first thing. It's actually written in second, but this is the second, slide in that manner. But this is the first strategy. So time of day exploitation, the retail blind spot. Market behavior is not constant. It fluctuates significantly across different trading sessions. Understanding these shifts is crucial. So even if you're trading, like for example, let's say you're trading Bitcoin, let's say you're trading NASDAQ, or whatever you're trading, in different sessions like New York session or Asian session or Tokyo session, you would have different kind of movements, different kind of volatility, different kind of average move percentage, right? Because all those sessions have different kind of intended market makers or intended traders, right? So for example, the Asian session is often characterized by lower volatility and consolidation. The London session is often, oftenly it's like increased volatility and liquidity, because when the London session starts, the people or the firms or the hedge funds or the traders, in UK or in the States, they wake up and then they try to trade, right? So thus marking significant moves. And then, for example, there comes like New York session. So again, high liquidity, strong trends, and often overlapping with London for maximum activity, right? So many strategies designed for trending markets will fail in low volatility hours, not because the strategy is inherently flawed, but because it's applied in an unsuitable environment. So by filtering trades to high activity windows, the same strategy with the same rules can yield dramatically different expectancies. Now I will show you some, data to back it up, but the key takeaway is remove the worst hours, not the strategy itself. So let me just show you some things I have on here, like on BTC, right? This is an indicator that we coded. And if you don't know us, you can just, Google Nexus Ledger, or you can visit us on here. And yeah, this is us. We basically work for fintech and trading automation. So custom solutions for fintech and trading. But anyways, let's just come back to the topic. So I'm going to show you something. So let's just go to the setting. And when we go to the setting here, yeah. So here you can see that we have sessions here, and the history days that we are taking is 100. And then there's, for example, Asian session, right? So you can see in this dashboard here that in Bitcoin, let's say, the average percentage of move over like 100 of periods, it is 0.3% in positive. So Asian session in the recent times have been positive in the movements, while the London session for Bitcoin specifically has been negative. right? So even though it's popular that London sessions usually bring a lot of um, liquidity, or sometimes they also say that it's a session where positive moves are expected, but those sessions can perform differently for different assets, right? So you can see here the average move for the Asian session in Bitcoin is 0.37% in positive. And the efficiency, now what is this EFF that we had coded here? It's basically how smooth the moves are, right? So Asian sessions are not so smooth, right? And you can see it here as well, and also in the slide as well, that it's lower volatility and consolidation. So it's not smooth in the trend efficiency, right? But the New York session has been the most trending environment kind of thing, above 50%. It's 57%. And also you can see in the slide that we had said that, New York session is high liquidity and strong trends. And again, you can, apply this on, for example, we do on NASDAQ. So let's just go here. Now for NASDAQ, you can see that these sessions vary too much, right? Because of course, Bitcoin is too much volatile, so you would see like it's just 0.03%, right? But Nasdaq 0.03% is like, for Bitcoin is like 1%, right? You also have to see that in perspective. But again, New York session again has been, the session where the trends, are actually formed, or the moves are very smooth. The trend is smooth, right? There's less choppiness in the market, and this is true in Nasdaq, also in Bitcoin, or the last 100 periods. So this is, just the slide. Now let's just go back to the next slide. So let me just yeah. So regime filtering: trade only when favorable. Strategies are not universally effective across all market conditions. Identifying and trading only within the favorable market regime is paramount. So what do I mean by that? Let's say you have a strategy that's related to trend trading, right? So the good old trend trading. And the mistakes a lot of people make is they would have a trend trading indicator, let's suppose the basic one, but still very powerful, is the EMA, right? So we have, wait a second, exponential. Yeah. So the EMA. Now you can see that, for example, when I make it 200, so let's just make it 200, so we can see the smoother trend. So even though we have done it, 200, which is, people say that it's very strong, but you can see a lot of times it actually did not respected the EMA, right? A lot of times here the trend traders were failed. And why were they failed? They were not failed because their strategy is inherently bad. They had failed because this market regime over here was actually sorry was actually in choppiness. It was not trending. You can see the price of Nasdaq for about 4 to 5 hours in the 1 minute time frame was just ranging, right? So how would you expect a trend trading system to work good in an environment that is actually ranging, right? So this is not a problem of your entries or your risk reward or your win rate. It's a problem of regime as well, right? So let me give you a good example. Let's just say, so here you can see that this period of about 1 hour was also ranging 1.5 hour, right? And then the EMA was not respecting it. So then the trend actually started, and then the price came down, and then it took the support, and then it went up, right? But these are just some basic kind of things that are very important to understand, that strategies are not universally effective across all market conditions. So, for example, if you have a low volatility, periods of tight ranges and reduced price movement, of course, when there's transitional, this is where market conditions are shifting, and then there's expansion, periods of strong trends and significant price action. So strategies often fail in specific regimes. Implementing filters based on volatility and spread ensures that your strategy only operates when the probability of success is higher, right? And let's just go to the next slide. And then I also have some other thing to show. Wait a second. Yeah, so for the previous slide, I have to show you something, which is the time of day exploitation. So same strategy, different hours. Okay, so I have to show you a Python based, simulation as well. So let me just put up this, and we can see here that when the same strategy was working 24/7, right, not caring about which session it is actually, being implemented on, the the portfolio actually went down, right? It went down, and then it went up, but it was still down a lot by the filtered hours only. So when you're actually trading in the regime or even in the session which actually aligns with your trading strategy, it improves your expected value, it improves your compounded returns by a big margin, right? And this is, you know, a proof in front of you, but through simulations. So now let's go to the fourth slide. Okay, so the fourth slide is basically return skew hijacking. So it's basically beyond win rate. Okay, so it's focusing solely on win rate can be misleading, right? So if you just focus on on the win rate, like like my win rate is 50%, 70%, all those things can mislead you. So true profitability often emerges from the shape of your return distribution. Now this is a very important concept. Now, this is known as the return skew. So, understanding return skew, what it means in the traditional viewpoint is that high win rate is equal to profitable, which is absolutely false. You can have a win rate of 70% and still be unprofitable if the return that you're making in comparison to the risk is not aligned with your win rate, right? We all know that. So, the quantitative view is basically that profitability from many small control losses offset by rare, very large wins. So you have a skew, you have like these very small losses, right? And then you're just waiting for that one big profit, right? And then that just, boosts up your portfolio. And then again, you have small losses. And then again, the right tail of your strategy actually hits, the skew hits. And then again, boom, you're up, right? This is what the concept means visually. So by adjusting exit behaviors, we can reshape the right tail of the distribution where the big outliers are. So creating an equity curve characterized by flat periods followed by sudden significant jumps, which you can see in the image as well. And I know this is an AI generated image, but the ideas are all that we work on Next Ledger. All these strategies we actually implement them in real markets. But yes, of course, this slide is generated by AI because this era is based on AI, right? So we just have to save time. So again, key idea is profitability comes from the shape of the distribution, not just trade accuracy, right? So what do I mean by that? So the thing that I mean by that and this whole, return skew hijacking is that if you can also manage the way you exit your trades, you can try your best to actually manage your skew or the big, jumps that you get from here. And I'll talk about it in the next slides on how to do that. There are some things that we'll talk upon, like, pyramiding, or you can even implement option hedges. And, Nassim Taleb in his book actually talks about this as well. But this is that idea. So let's just go into the next slide. So this is an interesting one. Fractional loss financing. This is a kind of risk prepayment engine. So imagine building a cash flow shield around your main trading strategy. This concept involves using a secondary high probability engine to finance potential losses. Now this is some, this is a diversification kind of a strategy, or a portfolio that even, Ray Dalio, the hedge fund manager, the everybody knows him, talks about is that the only holy grail that he has found in trading is actually diversification. And that's true. Like, uh, in a way, it's true. because now, for example, you have the main strategy, and where, for example, you're risking 1 hour per trade, right? Just so you can understand. And this is potentially volatile strategy. So then you would have a secondary engine, a secondary strategy where you are using high probability scalping, in which you're, for example, risking 0.3 hour per trade, right? And then what's going to happen is over a month, a significant portion of losses are already financed by those high probability scalping that you're taking. And if this loses, then this is making money, right? So of course, if both of these both of these engines lose, which of course can happen, in the world of probability, it's gonna, lose your portfolio, but that happens very, very rarely. So the core idea is simple. The main potentially volatile strategy doesn't need to be safe if it's financially insured by consistent smaller gains from another source. Now let's just go to another slide. Yeah, this is the sixth one. Okay, so reversed logic entries. So exploiting step out zones. Retail traders place stop losses for protection. However, these zones often become liquidity pools, and even sometimes the order book is very thin, so the prices actually go very vicking, or they go up and down, and thus the retail traders get, stop hunted, and attracting large players and accelerating price movement. So the information in stop losses. Retail stop losses are often clustered, creating areas of high liquidity. When these stops are hit, price often accelerates in the direction of the large players. Instead of avoiding these zones, treat historical stop levels as valuable data points. The strategy involves fading, trading against, or joining liquidity runs again around these common stop loss zones. These zones contain critical market information, not just risk. So if I have to sum up this, thing in like a few sentences, it's just this simple. Where normally as a retail trader you put your stop loss, for example, if you're putting your stop loss, like you're saying, okay, um, this is the resistance, right? So the price is here. You're like, okay, this is the resistance, and this area, and then you're like, okay, let's just put a short. But instead of putting a short here, you would put a short where your stop loss would be. So let's just assume that if you're putting a short entry here, you would put a stop loss here. But then when you're using this strategy or this kind of thing, you would put your entry here, and then this way your stop loss also gets very thin and short, thus giving you good risk to reward ratios, also increasing your probability at the same time. And this is a very good thing to do. And of course, if you put your entry at where theoretically your stop loss would be, of course you would miss a few of the trades, but the the way you have set up your trades actually will be extremely high quality in every sense, right? You're getting a good probability, you're getting good expected value from the trade, you're getting everything that you want, and you're only missing out on few trades that would be inherently bad as well. So let's just go into the next slide, and that is pyramiding. So pyramiding into strength. Compounding proven trades. True compounding in trading comes from adding exposure only when the market confirms your initial thesis, not when averaging down on a losing position. So, initial small position you have, and then you enter with minimal risk, testing the market's conviction. And then when you have the confirmation, then you only add exposure after the market moves in your favor, confirming direction. Compounding wins, so losses remain capped at the initial small risk, while winners grow non-linearly. You have to focus on this word, non-linearly. So it's exponential growth with added positions. This disciplined approach ensures you increase your exposure only to certainty, allowing profitable trades to amplify their gains without increasing the initial capital at risk significantly when you're testing your trade idea. This is a very big concept, a very important concept for you to learn. So let me just give you an example. Again, you can apply this to any asset, any pair. You trade crypto, forex, whatever you're trading, you can apply this thing. You can apply all those concepts that we are teaching here, and this is just a video for the community for free. So let me just remove the drawings and um, yeah. So um, okay, let's just say that you want to buy. Okay, let me just bring that EMA up again. So there's EMA 200, right? So you're like, okay, this is, let me find a training environment. So here it is. Yep. Here it is. This is a good example. So let's just say that, the price is in a downtrend, it's below the EMA, and then you're like, let me just hit with the short. Now, normally you would go, your full size on the short, and then you would get stopped out, and then you have lost um your whole stop loss money into this trade idea, and theoretically you're just trying to catch a knife because you exactly do not have the confirmation. Instead of that, what you can do is you can add a small portion of your position here. So let's just say if you're selling with $100, you would sell with $10 here, right? And instead of you know, adding on to the loser, you would add on to the winners. So you would actually wait for the price to confirm. So let's say the price came down and then you added you added $20 more, and then you realize that the price actually has given a confirmation, but then the price actually went up. So you still saved your position by a big margin. You only lost the stop loss for the $20 instead of the $100. And this would work a lot of times in your favor. And this would actually reduce the drawdown and would increase the returns that you're making, thus giving you an exponential growth. So now, this is also an interesting one, which is diversification with two bad strategies. A single strategy, even a profitable one, can be fragile. Counterintuitively, combining two uncorrelated, now you have to focus on this word, uncorrelated, losing strategies can form a robust and profitable portfolio. So strategy A, let's just say, performs poorly in trending markets but thrives in ranges, and strategy B excels in trading markets but struggles during consolidation. So when combined, their weaknesses offset each other. Where one loses, the other gains or break evens, leading to a much smoother and more stable equity curve overall. The portfolio logic can be far more powerful than individual signal logic. This is a very interesting concept that you can ponder over a cup of coffee or whenever you want to. So now we're coming to the end of the video. So the meta system synthesis, and this is just a close of the video, which is the true power lies in stacking these quant overlays to engineer a robust, profitable system, even from a Medicore, yeah, core strategy. So, for example, you can have, you can use time filters, you can use regime filters, skew control, and all those things that we had talked upon on this video. And remember, the core strategy was never fixed. The money flow and contextual environment were engineered for profitability. Okay, you have to remember this thing, that the money flow and the contextual environment were actually engineered for profitability. A new perspective on trading. So retail traders optimize entries, quant traders optimize return distributions. Profitability is ultimately about shaping outcomes, not predicting markets. This approach reflects the system building philosophy actually that we use at Nexus Ledger, where we build quantitative methods to transform trading potential into consistent performances. We build everything related to trading and fintech. So if you want to build a custom solution for yourself for trading, or an algorithm or an indicator, or even want to build yourself a full-fledged platform, you can contact us by visiting our website and just contacting us on our email, or just going into the services and getting a free code. Thank you for watching this video. I hope you liked it and you found it educational.